Stock-based compensation, or SBC, has exploded over the last decade, creating massive wealth for executives, but sometimes destroying value for shareholders. When analyzing a company, you should pay close attention to stock-based compensation. In this video, we will learn how to analyze a financial statement to find out if the stock-based compensation is destroying value for shareholders. The stock-based compensation is a non-cash way of paying employees by way of issuing stock options as part of an overall compensation package. The purpose of stock-based compensation is to create an incentive for talented employees and executives to stay with the company for a given period. It can generate value for its shareholders by keeping the employees and executives motivated. The problem with stock-based compensation is that, although the company will not spend cash, the shareholder will be diluted by the stock issue. For example, let's say that a company has 1 million shares in the stock market and you own 50,000 shares, which represent 5% of the company. If the company issues 100,000 shares, the total shares will be 1,100,000, but you will still own the same 50,000 shares, which will be 4.5% of the company. If the stock-based compensation expense is low relative to the company's revenue, it is not a big deal, as it will not have a huge impact on its earnings. So, in this case, there is no problem with the stock-based compensation. It can generate value by keeping the employees and executives motivated. However, several unprofitable companies spend a huge amount on stock-based compensation in relation to their revenue, and many of them exclude the SBC from their non-GAAP net income. That is why it is so important to always look at what the company is adding or subtracting to the non-GAAP net income when analyzing a financial statement. Let's check a real example of how we can identify stock-based compensation in the financial statement of a company. This is the 2021 annual report of Palantir. In the cash flow statement, there is the line stock-based compensation. In the case of Palantir, this value was $778 million. When we look at the revenue of Palantir, it was $1.5 billion, so the stock-based compensation corresponds to 50% of all the revenue. That is a huge amount. When we look at the company's financial summary, we can see that they reported an adjusted operating income of $473 million and an adjusted net income of $308 million. But when we check what was the adjustment that the company made, we can see that they excluded stock-based compensation from the calculation. If we put the $778 million from stock-based compensation back in, the adjusted operating income would be a $305 million loss, and the net income would be a $470 million loss. Many companies remove the stock-based compensation from their non-GAAP or adjusted net income. Warren Buffett wrote that excluding stock-based compensation is the most egregious example of managers telling their owners to ignore certain expense items that are all too real. If compensation isn't an expense, what is it? And if real and recurring expenses don't belong in the calculation of earnings, where in the world do they belong? I agree with Buffett. It does not make sense to remove the stock-based compensation from the earnings of a company. So, when analyzing a company, you should always look if the company is removing the SBC from its non-GAAP earnings. And if that is the case, I think you should add the value back in the calculation, as we added in the Palantir example and discovered that the adjusted net income without the stock-based compensation would be a $470 million loss instead of the $308 million gain reported by the company. I'm not saying that Palantir is a bad or good investment. I'm only saying that you should use the numbers with the stock compensation value when analyzing the company. Now, let's check Apple. In 2021, the stock-based compensation was $7.9 billion, but when we look at the revenue, it was $365 billion. The SBC only corresponds to 2.1% of the revenue. Apple had a $94 billion net income, so the stock-based compensation is not a problem in this case. There are several examples of companies that exclude stock-based compensation from their non-GAAP net income, especially non-profitable tech companies. So, you should be careful with this when analyzing a company to invest in. Many people don't even analyze the financial statement of the company they invest in. This can be a huge mistake in the stock market. The financial statement is where you will find out the information to properly analyze a company. You need to know how to read and interpret the financial statements. In the book Warren Buffett and the Interpretation of Financial Statements, we can learn how Warren Buffett reads a financial statement and what he is looking for in a company. You can check the top 5 lessons from this book by clicking on the card on the screen. Bye!